Hello, this is Ann Jones, Webcast Manager at PRMIA, and I am pleased to welcome you to this PRMIA webinar. Today, Dr. Jörg Kienitz will present non-Gaussian models. Jörg Kienitz is the head of quantitative analytics at Deutsche Postbank AG. He is primarily involved in the development and the implementation of models for pricing and hedging complex derivatives, and embedded options in retail products as well as for asset allocation. He lectures at the universities of Oxford, Bonn, and Duisburg on advanced finance modeling and gives courses for market professionals on applications of Monte Carlo methods, non-Gaussian models, numeric methods, fixed income derivatives, and other mathematical finance topics. Jörg lectures at major finance conferences including Global Derivatives, WBS Fixed Income, and Risk. He holds a PhD in Stochastic Analysis and Probability Theory. Jörg authored several papers on mathematical and computational finance and is co-author of the books Monte Carlo Frameworks, Building High-Performance C++ Applications in C++, and Finance Modeling, Theory Implementation and Practice with MATLAB Source, published by Wiley. Please feel free to submit your questions to the presenter via the question pane on the right-hand side of your screen at any time during the presentation. Audience questions will be moderated by PRMIA's Training Director Alex Voicu and answered by Jörg at the end of the session as time allows. Following this webinar, a link to the presentation will be emailed to you along with a link to the recording of today's webinar. So now, Jörg, I will turn the presentation over to you.
Yeah, thank you very much, Anne. And let us start with this webinar on smile modeling and non-Gaussian models. Let us start with the agenda for this webinar. So we have all in all 3 parts. So the first part is on market structures and applications of non-Gaussian distributions, and we have several examples which we discuss. So first of all, we would study a little bit of market data and especially implied volatilities which can be observed in option markets. And on the other hand side, we consider examples of statistical distribution. This is mainly based on time series analysis, which is very important for valued risk computations and asset allocation. The second part then is on modeling the smile. So there are many models which can be used to model the observed phenomena, the market smile, or as we will see in a moment, non-symmetric and fat-tailed distributions, and I have chosen the Heston model and some types of Levy models as some typical models which can be used to model this phenomenon. There are many others, as I said, for example, in the fixed income and in the FX markets. You may know the famous Saber model. This is not covered here, but I think the interested listeners will find many more examples and material in the financial modeling book, which is displayed on the right hand side here. From this book there's also the third part. This is an example of model risk. It's based on calibration hedging issues, and we use these advanced models which are capable of smile modeling and fat-tailed distributions, and we study it on the DAX data and see how model risk comes in, how these issues with calibration and hedging lead to new model risk issues when we wish to apply these advanced models. So let us start with the market structures in options and time series, the statistical distributions. And I have a quote here from the famous Harry Potter book. It's "Dark and difficult times lie ahead. Soon we must all face the choice between what is right and what is easy." And yeah, this is somehow what we are facing at the moment in the financial markets. So we have many crises, euro crisis, we had the subprime crisis, and yeah, some of these issues can be blamed on using wrong models, or models which do not really show all the risk which is embedded in financial markets and financial markets transactions and so on. So we have on the one hand side a nice world where we can model everything with one single parameter, which is called the volatility. This is the Black-Scholes world. Everything works and relies on this parameter, but this parameter only gives a very limited access to risk, and I will show where it goes certainly wrong in the next few minutes. So first of all, we try to find some evidence for the need of non-Gaussian models. With non-Gaussian, I mean that we do not assume that the log returns are normal, so we do not assume a Black-Scholes world. And yeah, one evidence is, for example, the option market. So I have here the surface for DAX options. It is on 4 different dates in 2007. So it's in January, it's in March, in September, and again in January, but it is now 2008. And what we see is that not only the height of the volatility surface has moved during time, but also the structure itself. So first of all, we observe it is a surface, not some flat thing, but it's really a curved surface. And we observe that this surface evolves. It does not stay the same. It can evolve in terms of height. It can evolve in terms of curvature and slope and so on. So we see that there is really some stochastic volatility, as we will call it, because the implied volatility observed in option markets does not stay the same. It moves over time. And this can clearly be not covered with a single parameter like in the Black-Scholes world. So in the Black-Scholes world, we always would have a flat line, a flat surface, and this surface only can move in up and down. So this option surface for this DAX index is much more complicated. And if we consider the DAX time series, yeah, this is just the data you can find at a data provider, for example Reuters or Bloomberg. You just take the historical data and plot it. So I wonder if anybody is familiar with this time series analysis, and there is a certain way of how mathematicians look into data. So it's not the plain time series data, but we need some more another notion which we can mathematically grab and model. So here I formalized the definition of a time series. So if we take the DAX time series, it could be represented in this form. So X in this case is a realization of the DAX time series at time t, and t is out of some discrete time set, which I call calligraphic t here. And the set t is ordered. It has some starting point, which I call t start, and it ends at t start plus n times tau. And what I want to say with this notation is that from starting at t start, I go ahead of in time of one period which is of length tau, and this I do n times. So for example, for this DAX series, I would start at the 14th of December in 1993 and just take tau to be 1 day and picture each closing price of the DAX data, and this would then correspond to this time series. And what we need for mathematically modeling this stochastic notion is that it is independent and identically distributed. So this random variable, this realization of a random process of some random thing, has to be independent and identically distributed. Otherwise, it would not make any sense to go on and study this. So how could we have a rule of thumb to consider if some given time series corresponds to one of an independent and identically distributed random variable? To this end, if we think we have found some so-called invariant, we can apply the following rule of thumb, which goes as follows. So we have these realizations here. This is the first point. We take the realizations and we split the time series into 2 parts. So first part is called xt1, and this starts at t start and goes exactly time minus t start over 2 tau times 2 tau. And the other time series is taken to be the right half, so starting from the ending point of the first time series and going until maturity, which would then be tau start plus n times tau, which is here denoted by t. Then one plots two histograms corresponding to the realizations of x1 and x2, and we also plot the lagged time series. And now we see what we get. So independence, if you think, for example, of a Gaussian distribution, would result in the following graph. So independence would show as a kind of some kind of behavior which is where all the realizations lie within a circle here. And this is clearly the case on the left side, upper left side of this slide. If we have a strong positive dependence, so not independence, it would result in a graph like this here. So reaching from the lower left of this scale up to the top right here. And in the case of negative dependence, it would just show up as the figure here on the bottom of the slide, and this would correspond to negative dependence. So if we just plot the time series and we observe one of these structures, we would abandon the assumption that we have found an invariant. But if it looks like this, we can be at most sure that we have found an invariant. Then we need furthermore to independence that we have identically distributed things. And for example, if we would plot the histograms of x1 and x2, and it would show up like this one here on the red box, we would see two very, very different histograms, and those would clearly not lead to any identically distributed random variables. So the distributions look quite different here. The green box here on the bottom shows two distributions which look very nice. So these correspond to some nice objects, and they seems to be that these objects are good related, and that they show some kind of identical distributions here. And now we might ask the question on what are invariants which we can model. So if we do the test, this rule of thumbs test on independence and identical distribution with a pure price data from the DAX series, for example, we do not see any success. We would end up in a picture like this, for example. So this one here is for the DAX data, and exactly what I have shown is that we end up with some kind of very, very strong positive dependence here. It's not only for DAX data, but we can do it on the Nikkei, we can do it on the FTSE, or on the S&P 500. So if we take some time series and we just simply take the prices, the closing prices for daily data, for example, we would end up with such graphs here. And this is not really what we want. We want these circular pattern, and therefore we have to look into other things which might qualify as an invariant. And in fact, what qualifies as an invariant, at least for the index data, is the returns. So in this case, I have written down or plotted the returns for this DAX series. So this return is calculated as the price, the closing price at some date, divided by the closing price of the day just before, -1. So it's a kind of relative difference. It's not an absolute difference, it's relative difference. And now the picture looks quite different here. So we face here some kind of movement in the relative performance of the DAX, which has here some regions where there's a high changing of the relative dependence, followed by even higher ones. Then there's a calm part of this changing of relative dependence, and then we face again some big changes and so on. And I will argue that this was really the thing we have to consider as an invariant, and this is in this case the returns of the time series. So now if I'm going to plot the halved time series, so x1 and x2 for the DAX, just for the returns, I would see this circular pattern here for the Nikkei, for the S&P, and for the FTSE. The other part of the test was to plot the histograms, and therefore I go back to consider the histograms of the prices. So for the DAX we do not see any nice probability distribution here. For the Nikkei, S&P, and for the FTSE we also cannot see any nice pattern, any distribution here. But if we do it for the returns, we would see here, for example, the DAX shows a very nice probability distribution, the same for the Nikkei, the S&P 500, and the FTSE. So the other thing which I want to stress here is we have found an invariant. We can analyze this invariant, but we also see that it is clearly not a Gaussian random variable. Here, this line shows a moment-matched Gaussian distribution. So moment matching means that I have fixed the expectation from the returns, and I have taken the variance of the returns and plotted the corresponding Gaussian distribution. So here we have the mean, and this corresponds here to the variance. And what we see is that the data we have considered, for example, for the DAX, is much more peaked, and it's skewed, so we have more mass here on the right-hand side. But it's not really good to see in this figure is that we have also fatter tails in here. So it's not the right scale to see fatter tails in this. I will have a table in a moment where it becomes obvious that there are fatter tails in the distributions. The same holds true for the Nikkei. So we have a very peaked distribution calculated from the time series data, and a corresponding moment-matched Gaussian distribution does not really describe the distribution very well. The same we observe for the other two indices, the FTSE and the S&P. So this is the first hint for non-Gaussianity in the models for statistical returns, say for time series data. And again, if we consider the log returns of the DAX, or the returns, you can take both as an invariant, and you look at the time series, you see that this does not correspond to some kind of Gaussian distribution with a constant volatility. If we would have a Gaussian random variable here and plot the corresponding log returns or returns, we would see some kind of big black fat line here. So there would not be any times where there's a high volatility, so a high change of logarithmic returns or returns in here, and also here on this kinds of very big returns, negative returns, small positive returns. And this is also a hint that the invariant has no Gaussian distribution, and that we have to take care of this. So another thing might be that we might use this invariant stuff only for index market, but I have also shown it here for fixed income rates. For example, I've taken the euro swap rates. It's the 1-year swap rate, 2-year, 10-year, and 20-year swap rate, and we see this, or we observe the same thing, that the time series of the returns, or in in this case it's a yield to maturity of the swap rates. It is a kind of return of fixed income rates. It corresponds somehow to the observation for indices. We have periods where there's a lot activity going on. There's a period where it is calmer, and there are big negative and positive returns in the 1 year swap rate time series. The same we observe in the 2-year, 10-year and 20-year swap rate time series. And if we plot the distributions, we also could see that the distribution is highly peaked, and in this case we see that there are quite a lot realizations of big negative returns or big negative changes in yield to maturity. So we have some outliers here which would not be there in a Gaussian distribution. So therefore these distributions here, they have fat tails. There's much more mass in the tails of the distribution as we would observe or as we would expect when it were Gaussian. So therefore it makes sense to consider other probability distributions than the Gaussian distribution for modeling indices or fixed income rates. Okay, so we can ask ourselves what might be a good idea to characterize other distributions than the Gaussians. And the Gaussian distribution is just described by two parameters. So the first parameter is the expectation, which we call mu, and the volatility or variance. The variance is the square of the volatility, and this is denoted by sigma. So once we know the expectation and the volatility, we know the whole distribution if we work in a Gaussian model. And I've written down here the definition of these parameters, and I also gave the sample notions for the expectation and the volatility. So this can be calculated from a time series. So the xj in our case would then be the returns or the log returns of the time series or the yield to maturity of the fixed income for swap rates, as we have shown. So in a non-Gaussian world, there are, of course, higher order moments. So the non-Gaussian distributions cannot be described by just two numbers, the volatility and the expectation, but we have to take into account higher moments. For example, the skewness, which is given here as a kind of third moment, and on the other hand side, the kurtosis, which corresponds to a fourth moment. And so the Gaussian distribution has no skewness, so the skewness would be 0, and it has a kurtosis, I think it is equal to 3, and other distributions can be compared to the Gaussian distribution. So it's, for example, in terms of skewness, if it is positive or negatively skewed, if it has a skew of positive value or of negative value. So once we can we compute the skewness from the time series and we observe that it is either negative or positive, it would not correspond to a Gaussian distribution, and the same for the fourth moment, the kurtosis. And these are very important issues when we deal with time series. So another reason why we consider time series might be for asset allocation or value at risk computation. So what is the issue when we want to do asset allocation? We have to optimize the risk and return profile of a portfolio. So the portfolio can consist of any financial instrument. It could be a portfolio of bonds, it could be some equities, some indices mixed with bonds, with derivatives even, and we want to calculate an optimal risk-return portfolio. So therefore we have to find a measure for risk. In the Gaussian world, this is volatility. So this is the very simple Markowitz model where everything is risk attributed in terms of volatility, and this can be solved very easily, but as we have seen in the real life, we do not have Gaussian models anymore. So how should we cover asset classes which are not Gaussian, and how could we quantify something which corresponds to risk, to volatility in the Gaussian world? Here, as I promised, I have written down some evidence for fat tails. So a daily loss is observed in a typical index with an empirical frequency of 0.5 years. In the Gaussian world, 0.3 years. So this is quite similar. Daily loss of 2% in the empirical world, we see it in 1.7 years, in the Gaussian 1.2 years. Daily loss of 3% in 4 years, and here in the Gaussian world in 260 years. And if we just consider daily losses of 10%, we would see it in empirical data every 252 months. And in the Gaussian world, it would be a very, very big number. So we could say in a Gaussian world, daily losses of 10% are not there. So therefore, we see that the empirical distributions have much more mass in the tails. So at big events, say losses of 10% or gains of 5, 7, or 10%. So this is an evidence for the fat tails in the market. So now we have to classify what we understand as a risk in non-Gaussian models. And to this end, we have to look into a little bit into probability. And here I've depicted the probability distribution. Say this could be the probability distribution for losses. So I have the losses here on the y-axis and the values of the losses on the x-axis. And the green line here corresponds to the cumulative distribution, which sums up to 1 at the end. And I can consider 2 quantiles. So the first quantile is the value at risk. The value at risk is given for a prescribed level, which we call A, for example 1%. And the value at risk then is the maximum loss not exceeding with a probability of 1 minus A. So if A would be 1%, it is the 99% quantile. And therefore we do not assume or expect any losses higher than the quantile var with a probability of 99%. Another risk measure would be, which we call the conditional value at risk, and this is the expected value of the cost in the 99 or in the 1% of the worst cases. So if we are in the tail of the distribution, so if we have an event which lies to the right of the value at risk, and if we would then calculate the expected value of being in this area of the distribution, this will correspond to the conditional value at risk, or which is also known as expected shortfall. And interesting thing is that for the Gaussian distribution, the wider we go outside, that we do not see any effect. So we see this picture here is meant to illustrate that the Gaussian distribution does not have fat tails. They are falling down rapidly, and we do not have any mass in the tails. So the Gaussian distribution is very tame. If you want to consider tail events, you do not go into modeling with a Gaussian distribution, but you have to go into other distributions. For example, the T distribution with a certain degree of freedom. Here I've depicted the T distribution with 3 degrees of freedom and 4 degrees of freedom, and we see that corresponding to the degrees of freedom, the tail risk is much, much higher, and therefore the value at risk is much, much higher. Again, for the conditional value at risk, we see that the Gaussian distribution does not really differentiate between these two risk measures. So we can take the value at risk or the conditional value at risk. It doesn't matter for the Gaussian distribution. But for the distributions with other tail risks, like the T distribution, we see that it clearly differentiates between these risk measures, and they are really different. So if you have a value at risk system and you use a Gaussian model, it does not take or does not play any difference if you use value at risk or expected shortfall as your risk measure. The Gaussian distribution does not recognize that. It's nearly the same number, but if you use a distribution which is capable of tail risk, you really see a difference between these risk measures. And this can also be used for portfolio asset allocation. If you optimize a portfolio with respect to a value at risk or conditional value at risk, you can calculate these risk figures also for non-Gaussian distribution. You have to put in or put forward a much bigger machinery for calculating this risk figures and determining your portfolio weights, but it could be worth it if you want to take into account other distributions, skewed distributions, or distributions of with fat tails. So you have given just 3 examples. So the left one here is the mean variance portfolio. It's the same data I've used. So this is the Gaussian world here. This is a Gaussian world with views, the so-called Black-Litterman approach. And finally, an approach which can take into account complex, much more complex distributions. And we call it the Coppola opinion pooling approach, which is capable of considering much more complicated distribution, which are much more complicated dependence structure. So, and we see all in all that it leads to different allocations. For example, in the Gaussian world, there is no real allocation of asset A1, whereas in the other approaches, there is some weight in this asset. So you really get different allocations if you work with tail risk and skewed distributions. So the first thing I wanted to show, and this summarizes part 1, is that we have evidence for non-Gaussian models in options and time series, that we have to model invariance. Different market quotes show that we need to model the skew, the smile for derivatives pricing, and also if we consider statistical distributions, we have to rely on non-Gaussian distribution because the invariants are really distributed with respect to non-Gaussian distributions. So therefore we have in financial modeling the need for non-Gaussian distributions. And therefore I come to the first questions. First question for the poll. So if we consider a time series data, what do you think are the right numbers to look at to determine the real world distribution? Would it be the prices, the market invariance, for example returns or log returns, or would it be the prices of the difference of prices minus the start price? So the poll is open, I think.
I have launched the poll. You have 10 seconds to answer. I have closed the poll. I will share the results. We have 0 saying A, 87% saying B, and 13% saying C.
So the right answer was B, the market invariance. Okay, so now I will come to part 2, which has to do with modeling and modeling the smile in this case. So this is mainly based here on option pricing, but the corresponding models can also be applied to asset allocation and to optimization of risk and calculation of value at risk. So this, for this I have to refer to the book Financial Modeling, but here we touch the basic models which can be used for determining smiles and price options where we observe smiles in the market. So the first class of models which I want to consider is the class of stochastic volatility models. So some famous models are the Heston model, the displaced diffusion Heston model, or the Saber model, for example. Another class of models is the class of jump diffusion models. So many people know the Merton model, which is the famous Black-Scholes model, which is extended by jumps. But there are other classes of models which have no diffusion component anymore, so no Brownian motion component, and these are the pure jump models. These models fall into two classes. So one is the pure jump models, which are called Levy processes. The other one is Levy processes with stochastic volatility. I just want to show some examples and say what kind of smile structures we can build with those models. So I've chosen the Heston model with jumps, or the Black-Scholes model with jumps. I will show the effect of jumps. Then I take the normal inverse Gaussian model as an example of a Levy model, and the stochastic vol normal inverse Gaussian model. So first of all, the Heston model. The Heston model is given in terms of this set of stochastic differential equations. So we have two sources of randomness. The sources of randomness correspond to two Brownian motions, W1 and W2. W1 is the Brownian motion which mainly drives the asset. So S is the asset, the underlying index, for example. It could be the DAX or some other index or an equity whatsoever. R minus D is the riskless rate minus the dividend yield. And we have a drift term here, which is just this difference multiplied by the asset, plus then kind of volatility here, which is also governed by a stochastic process, times the index times the uncertainty. And the volatility, or the variance here, is also driven by some random source, W2. And this is a nice equation because we have three parameters here. This is kappa. Kappa is the mean reversion speed. I just say what it is. Tau is the long-time variance. Phi is the long-time variance, and nu is the volatility of the variance. So what does it mean? So this phi can be seen as the long-term level of a variance, and the current variance is always pulled towards the long-term variance. And this kappa here determines the speed on how fast this volatility of variance is pulled back to the long-term variance. And this stochastic movement here on this side just gives us a hint on how diffusive the behavior is. So if it is pulled back to the long-time limit, phi here, it is not a deterministic process, but it is a stochastic process, and this nu gives us the rate on how much it fluctuates when it returns to the long-term level. And both the asset and the volatility can be related, have a kind of dependence. This is modeled by some parameter rho. And here I depict the behavior of the volatility surface for different values of the parameters. So on the left-hand side you see the starting variance. So this would be the starting point of the variance here. And if we take the red scenario, which is our base scenario, and if we change the V0 by making it smaller, the whole volatility structure goes down a little bit. If we higher the value of V0, so the variance is higher, the starting variance, the whole volatility surface rises, and this is nicely depicted here in this graph on the left-hand side. If we change the long-time term limit of the variance, we see that the short part of the volatility surface is not affected by changing the value. But what we see is that if we rise the value, so the phi is higher than in the base scenario, the whole surface gets higher or rises if we go further in times to maturity here. So for the short part, we have the same values as in the base scenario, but if we increase the maturity of the options, we get a different value here, and the value of the blue, the higher scenario, is that the whole volatility surface for the long end rises up, whereas if we lower the long-term variance, the volatility surface decreases for the long end. Kappa, the mean reversion speed, has the same effect on the volatility surface as the theta here on this as the phi here. So in the base scenario, and we increase kappa, so that blue scenario here we see that in the beginning it does not change, but for the long end the volatility gets higher, and if we lower kappa, the volatility gets smaller. Then the other parameter is the nu here. The nu is the volatility of variance, and this has a nice effect, so it gives curvature to the whole surface. So if in the base scenario we have chosen some positive value for nu here, and if we increase the value, we get much more curvature, and we could control the shape of the volatility surface. If we lower the value of nu, the volatility of volatility, the surface gets not really curved, it gets a flat surface, and therefore we have a parameter where we control the volatility surface in this way. And the correlation finally is this picture here. So for the base scenario, I've chosen the correlation to be 0, and this gives a nice symmetric volatility surface. And if we increase rho, so that rho is some positive value, we get a skew here. So this symmetry is destroyed, and we get some upward sloping volatility surface in the case rho is positive, and in case rho is negative, we get a downward sloping volatility surface. So this is what we mainly observe in equities markets, and the blue one, which we observe often in commodity markets. So this is the famous Heston model, and now we want to include jumps in the model. So we can add, for example, to the Heston model a jump component. A jump component corresponds, just in this case, by adding a jump process. So the jump process is described by a process which determines a point in time where a jump takes place, and this variable y here, which is given here, determines how high a mean jump is, and also of how the deviation of this mean is realized. So this could, for example, be a Gaussian variable, so it determines the mean of the jumps and the volatility of the jumps, and this n here just gives the point in time where a jump takes place. So here I have depicted not the Bates model or the Heston model with jumps, but the Black-Scholes model with jumps, just to show the pure jump component. I do not want to give the stochastic volatility plus jump, but I just want to show what the pure jump component has an effect on the volatility surface. So in the Black-Scholes model, we remember that we are not able to model any curvature or any slope in the volatility curve. And just by introducing jumps, we were able to have a curved volatility surface, and therefore it is an alternative way to introduce curvature and slope into the volatility surface by adding a jump on a simple model. Of course, as I said, we can also extend a stochastic volatility model by a jump. And here I have just depicted the effect of adding a jump and playing around with the mean jump numbers and the volatilities of the jumps. So it gives also a possibility to control the behavior of the volatility surface. Now I come to another class of models which correspond to Levy processes, and for Levy processes we do not write down a stochastic differential equation. It gives not any hint on how the process looks like, but instead we write down the so-called characteristic function. I do not want to go too deep in this modeling or in this object. I just want to say that if you deal with pure jump process, the best way is, and this is always done in books, write down the characteristic function, because the characteristic function is the most easiest object for pure jump models and to model, to handle and to calculate with these kind of options. If you go into the probability distribution, for example, it is a much more complicated mathematical expression, and yeah, you should work with a characteristic function in this case. And here for the normal inverse Gaussian model, we do not have to concentrate on the mathematics here. We just want to show the possibilities of moving around the volatility surface. So for example, we can control the height by the parameter alpha. We can control the shape by the parameter beta, and we can also control also the height and the curvature by the parameter delta. So it also gives some kind of freedom to model the implied volatility surface. But clearly this is not enough. Oh, sorry. This is not enough. We can consider a little bit more complex modeling by adding a so-called stochastic time. So what do we mean by a stochastic time? You all know from your normal life or from your business life that there are times where nothing happens, so there's no much more new information, no market action takes place, it's a quiet market. But there are other very busy times. The market goes like mad, and everything's going up or going down, and this concept of a stochastic time models this behavior. So this concept of a stochastic time lets the clock not run at the same speed. So sometimes the stochastic clock is ticking very slow and nothing happens, but occasionally it ticks very fast and there's a lot of action. And this can be modeled, for example, by a Ornstein-Uhlenbeck process, Gamma-Ornstein-Uhlenbeck process, or by a Cox process. And the difference of these processes is that the Gamma-Ornstein-Uhlenbeck process models the information by dropping in and then petering out. Another source of information is popping in, it peters out, but maybe there is another information coming up, it peters out, comes up, peters out, and this corresponds to the stochastic time here. In this case of a Cox-Ingersoll-Ross process, the stochastic time is modeled as a diffusion process, and it is a little bit more continuous, of course, but it is a kind of zigzaggy line, and there's a kind of continuous fluctuation of the time, and the integrated path somehow for the stochastic time looks like that. So these are two different concepts of modeling stochastic volatility, or dropping in of information causing some action by the market. Do not want to go into details here. I just wanted to show, if you go into the mathematics, it can get a little bit complicated, so you have to go through some complex calculations, but nevertheless I have to stress the fact that you can handle this. So it's a mathematical machinery which you can use, and it gives you the possibility to use these complex models to pull it into some formula and calculate option prices like you do it in the Black-Scholes formula. And it's not really slow, it's really fast. If you implement it in a function and you use it on your spreadsheet, you wouldn't be able to say if it is a Black-Scholes pricing formula calculation or a calculation based on some complex pure jump model. So despite the fact that the mathematics looks quite complicated, the theory has matured, and you can use these pricing formulas as a Black-Scholes formula. And this is really good news, I think, that you can use the complex models exactly in the same way as you use the Black-Scholes formula. Here I have again given some volatility structures and some effects of the parameters which can in addition be used to model the volatility surface for a NIG, for the normal inverse Gaussian, combined with this stochastic volatility object, the stochastic clock or the stochastic time. So just to sum up, there are models for modeling smiles. For example, the Heston model as a very prominent example for the stochastic volatility models. The Heston model with jumps, it's a very popular model for a jump diffusion model. It is always often called the Bates model, and it is widely applied in equities pricing, for example. Then the normal Gaussian, inverse Gaussian model, it's an example of a pure jump model. And this is a very popular model, for example, in asset allocation, for example, in if you model hedge funds. So this is an important model in there, but also for option pricing. And finally, the GOU, Gamma, Ornstein-Uhlenbeck, normal inverse Gaussian model, which is an example for a more complex model, which gives us a little bit more freedom to model the implied volatility surface. But as I said, you can use all models also for asset allocation or for value at risk computations. So there are numerical methods available which can be used within modeling setup with complex model to calculate also risk figures. And finally, as I said, I have shown some implied volatility surfaces which are generated by the models. So for all the numerics, which I cannot discuss in this webinar, you can consult the book, and with the book there comes source code, and you can download it and play around with these models as you like. So don't hesitate to look into the source code and run the models. So this brings us to the second question for tonight, and it is concerned with the Heston model. So in the Heston model, it's, the change of which parameter leads to the following deformation of the smile. So is it the correlation, the rho? Is it the starting variance V0? Or is this the reversion speed kappa? So
I have launched the poll. You have 10 seconds to answer. I have closed the poll. I will share your results. We had 80% said A, 8% said B, and 12% said C.
okay, so the answer was rho. It's A. So this gives the deformation of the smile in here. Okay, finally, we consider the third part, which is meant for considering calibration, hedging, and the model risk, because if we apply a complex model and we want to use it, for example, in trading or in asset allocation or whatsoever, we have somehow to determine the model parameters. And this is the issue of calibration. And calibration is not really a science, it is more an art than a science. We of course need mathematical methods, we need numerics to perform a calibration, but calibration, yeah, you have of course to know a little bit the market, you have to know your model, so you will have that your calibration is stable, the calibration should be robust, and you do not want to have very different model parameters from day to day. So if you have a model in place and you calibrate your model and you observe that your model parameters change by a big amount each day, you should better think about using another model or using another calibration routine. So, and together with this calibration and this modeling comes the issue of hedging. Of course, you want to find out some risk figures which can be used for putting up a hedging strategy, and this is called the Greek letters. So you have to calculate risk figures from your applied model to set up a trading strategy which somehow offsets the risk in your portfolio. So as I said, the calibration is the process of taking some market data or historical data from time series and try to calculate model parameters out of this realized data. The hedging is that we want to secure our portfolio against movements of risk factors. And risk factors, of course, could be change in implied volatility. It could be change in the asset price. It could be a kind of dependent structure which can differ from time to time. And we want to secure our portfolio with respect to the movement of risk factors. So our hedge should behave, if it is a perfect hedge, exactly in the opposite way as our portfolio. So therefore, if our portfolio increases by 5 million, for example, the hedge should decrease by 5 million and vice versa. So when we use complex models, which are not anymore only Gaussian and in the Black-Scholes world, we have a certain amount of risk which we cannot hedge. If we not include, for example, other types of instruments like options, for example, we are not able to cover or to catch the whole risk of these models. So this red line indicates the risk which cannot be hedged. The other lines here indicate that hedging is not possible continuously, so we can only hedge or trade in discrete time intervals. So therefore, our hedge has two kinds of risks. So one risk which we cannot really control, and one risk which is determined by not being able to hedge continuously. And finally, we have to consider model risk. The model risk does not only arise by applying the wrong model. Of course, model risk is choosing the wrong model, but model risk is also there when we use different models, for example, for pricing and hedging. So we should rely on the same model for pricing and hedging purposes, so to get in line the corresponding risk sensitivities. And model risk does also show up in the calibration. So if we have a model and we have, for example, in the Heston model, two parameters which behave in an opposite way, so for example, increasing the volatility of variance and decreasing the long-term vol, or increasing the reversion speed, it could lead to instabilities. So especially if you have many parameters, it is not easy to really control the effects of the whole parameters on structures like implied volatilities or probability distributions. So there might be kind of a risk in this calibration process. And also this model risk shows up when we price exotic options. So it's the issue, if we have several models, we can price every traded instrument perfectly, and we apply all the models for calculating exotics. The corresponding exotic prices would really be very different, and therefore also the hedges would be different. I will indicate everything in the next few slides. So for example, I consider a very simple strategy which is called delta hedging in the Gaussian model. If we simulate a delta hedge in a Gaussian model, it nearly gives a a perfect match of the final call price payoff in this case. But in the non-Gaussian world, because of this part here, we cannot hedge. For example, in a stochastic volatility world, we are not able to hedge the stochastic movement of the volatility. If we only trade in the underlying asset, we see that the delta hedging strategy is not that perfect anymore. So we do not hit the call price payoff exactly. So there's a difference between hedging strategies in a Gaussian, non-Gaussian models. We have to consider other hedging strategies than delta hedging. Here we have delta hedging, the simulation and the hedge with different parameters, and even if the simulation and the hedge corresponds or are done with different models. So this I said at the beginning, so your pricing and your hedging should take place in the same modeling framework. So here we see what can result if you do not use the same model for pricing and hedging. Finally, I want to show a case study of DAX data option and different models. So here we consider all models we have covered so far, and additionally the variance gamma model with a CIR clock, Gaussian Ornstein-Uhlenbeck clock, and so on. And we calibrated all the models to the DAX market data. And here we see far off is the Black-Scholes model. As you expect, you have only one parameter to match all the option prices which are observed. This is impossible, and therefore the calibration error is so big. But other models show a very nice calibration behavior, and the calibration error is very small. So, for example, the Heston model, I have shown here the distribution of the parameters in the Heston model. So this is the daily changes in my calibration history, and I see that this is a quite good stable fit of the V0. It is a quite stable fit of the long-term variance. There are sometimes some values which are far off. It's not so good in a calibration, but for the Heston model it is reasonably good. Here you see the calibrated parameters time series, so each day in the history I plotted the corresponding parameter value, and yeah, sometimes, as you observe, for example here for the kappa, you get some strange jumps here in the parameter values. This is not what you want. I just included this slide to show what is not a perfect calibration. So in these other areas the calibration is quite okay. There's a not very big difference in the parameter values, but these things you should avoid in a good calibration process. Here I have done the same for the normal inverse Gaussian model. Here are also the parameters, so this one is really nice, and here you see yeah, that a kind of symmetry between alpha and beta, whereas the delta is quite stable and the others behave in exactly the same way. It indicates somehow that the corresponding structure is close to symmetry in this case. Finally, the Bates model. So this is the Heston model with jumps. I've also plotted the histograms of the daily changes of the parameters and also the time series in here. And here we also observe there are parts where are big jumps available. Could be due to market incidents which took place at this time, but it could also be some unstable calibration. Here finally the NIG-OU process, so this part corresponds to the NIG parameters, this part corresponds to the stochastic clock. Parameters A, B and lambda, and yeah, finally I will show how complex options, exotic options, can be used to differentiate between the models, and therefore I have chosen three types of options: Asian options, knockout options, and floating strike lookback options. And I have plotted on the calibrated data for each model the option prices. And often what you can observe is that the prices of these options, because there somehow gets the value of the index into the pricing equation, it would be better to consider the normalized option prices to see the real model difference. So for example, here for the arithmetic Asian option, these are the prices which are calculated using the models with the calibrated data. And on the right hand side you will find the normalized option prices. So by normalized I mean for the arithmetic Asian call, I divide at each time with the value of the corresponding call option price. And here you see the first thing is that the model, which is here, or which in this case here for the prices gives smaller values. For the normalized option prices, these models lie above the models on this side. So in fact, some models have much more risk in pricing this exotic option than we would expect from just considering the normal prices. This is also available here for the Asian put option. The model risk is relatively constant in this case, and you see it much better if you consider normalized option prices. So the same here for barrier options, and you see it very good in the floating strike look-back case. So the normalized floating strike look-back call prices, they clearly differentiate the classes of models. So the Black-Scholes model somehow is here. We have a Heston model in here, and the jump models, they lie on the lower side. Here on the option prices on the left-hand side, you cannot really see the difference between the models. So for example, the fourth line here is not visible in this slide here because it's close to one of these lines, I think this lower line here. But in the normalized setting, the normalized prices much better show the model risk which is embedded in the complex models. And yeah, the full study of this you can also find in this financial modeling book, where we have really described what we do, and we have provided all the data and all the scripts for plotting these figures. So to summarize, the model risk is everywhere when you use complex models which are of non-Gaussian type, and you have of course to take care of other things like setting up Monte Carlo simulation methods to price exotic options, to generate scenarios, and so and other things. You have to really care about the calibration, and what is most important, you have to secure your portfolio against market moves or risk factors from your model, and this is known as the hedging in the case of these complex models. So therefore we have the final question for tonight, and it is the following. So suppose we have a portfolio of financial instruments. What is the rationale for hedging? So is it A, make profit out of the movement of one or more risk factors driving the value of the portfolio? Or is it B, to secure the portfolio against a movement with respect to one or more risk factors? Or is it C, add financial instruments to your portfolio for which the risk factors cause a change in the same way as for the initial portfolio for leveraging?
I'm going to give you a couple seconds to look at his slide before I launch the poll, because they are truncated. I will launch the poll now. You have 10 seconds to answer. I have closed the poll. I will share the results now. We have 4% saying A, 96% saying B, and 0% saying C.
Okay, so B was a good choice. It's the right answer. It's the securing the portfolio against the movement of risk factors. Okay, so therefore that was all for this webinar. You can find related stuff in my books on Monte Carlo frameworks or financial modeling, which covers all the material and has much more additional material in it. So now I would answer questions if there are any.
Hi, Jörg. Thank you very much for the presentation. My head is spinning, but it seems that people were following the conversation very well, and I think we all need a more detailed course in the CU for a longer period of time than an hour. And for those of you who are interested, we are running an open enrollment course with Jörg Kienitz on May 23rd in Düsseldorf, and more information can be found on the PRMIA website. You were talking about model risk, and it's a very important variable. How often is it reasonable to review the pricing models to make sure that we didn't reach a structural break?
Okay, so I think you have to review your pricing model, I think, from a modeling perspective, not so often, but you have to take care about the market situation. So for example, currently everybody is using the SABRE model. It's a stochastic Ball model for the rates, and the SABRE model is somehow in the original form based on positive rates, and currently we see also in the euro market that we have negative rates. Last week the ICAP quotation for the cap volatilities, they broke down because of these negative rates, and therefore the whole market has to shift within a day or two to come up with a model which allows negative rates for the Euribor, for example. So this is really somehow triggered by the market, which can take place anytime, but I think you often have to, or you should always question your model and run some simulations and some hedging performance tests from time to time. So I cannot give you an interval which is daily or weekly, but I think you have to review your model and also the method for deriving your parameters constantly. So if you observe that there are some irregularities in your calibration, or that somehow you have the feeling that your risk sensitivities somehow jump much more than you would expect, this would be a triggering for reviewing your modeling, your calibration, and so on. So I would suggest to review it monthly, or but certainly keep an eye on that and try to find out if there are any jumps in the parameters and unforeseeable things. So
that's a very good point. Market returns are very hard to forecast, but a lot of people argue that volatility is much easier to predict. How well, in your experience, can we forecast volatility?
Oh, so I'm on the modeling side. I'm not on the forecasting side. So I might ask some people who to have a view on that. So there are some issues. So some quantitative models where you are modeling the volatility indices. So VIX, for example, for the stocks, and for the VDAX for the German DAX index. And I think there are some high correlations with respect to certain implied volatility structures, and which can somehow be used as a forecast for these volatility indices. So I personally do not have a strong feeling of how to predict volatility or to somehow forecast things. I think this is more with traders, or the view when you are in option markets. So yeah, it's not
sure. And sorry for putting in the wrong category. You mentioned earlier that everybody's using the SABRE model for interest rates. Is there any concentration risk, or is there any risk that everybody's solving for the same equation and the unknown will come in brutal fashion?
Yeah, we observed it exactly in CMS pricing. So CMS pricing is a pricing of so-called constant maturity swaps, and in constant maturity swaps you apply a static hedge which corresponds to setting up a portfolio of swaptions. These are simple swaptions, and using this portfolio you calculate the so-called convexity adjustment for applying for a constant maturity swap. It's a kind of adjustment to the forward swap rate, and everybody used Sabre in this setting to calculate these swaptions, and once the market quoted very small rates and very high volatilities. And the problem with Sabre is that it has problems for very low strikes, and if you calculate the density, the probability density applied by the Sabre option prices, you get negative values for this probability. And so there was some kind of, if you do not review your model and look a little bit closer into this, you might run into difficulties, and you do not see it directly. You just see it, for example, when you do not hit the CMS quotes anymore. So you say, oh, there must be something wrong. So it could be the model which is wrong, but then you have to dig deeper into the model and find out what's going on. And yeah, so there could be a problem just from using a standard model and not really thinking about what can go wrong even in a standard model.
Yeah, that's a very interesting observation and anecdote, which kind of takes me to Markov switching models, and we want your very honest opinion on them. Do you find they switch regime fast enough?
I've not really looked into regime switching models, but I think regime switching models, they have problems. So I really do not work with regime switching models. I do not feel comfortable really with these models.
Okay, that answers our question, I think. Very much so. There was a great table on slide 20 about the Gaussian world and the real world probability. It looks like a very distant universe. Are we ever going to drop the Gaussian models?
Yeah, I think so. I think several banks, they have also abandoned Gaussian models for value at risk calculations. I know from many banks that they have switched to these student T distributions, because the student T is somehow analytical tractable, and it has much more fatter tails than the Gaussian, as I showed on the slides. And yeah, so after the Lehman crash, for example, there were several statements in the news, in the financial news, of risk managers who said that there are some 5 sigma events which have appeared 2 times or 10 times in a row or something like that. So it's completely nonsense, because in the Gaussian world there are no 2 or 3 or 5 sigma events. So it has all to do with your distribution you choose, as you see on the table on page 20. So for a 4% losses, you need 10,900 months in the Gaussian world to realize such losses, but the empirical frequency is every 8 months. So yeah, the Gaussian model is not really realistic. And if you see, or it somehow shows that you have some confidence in your value at risk, in your risk figure, which is not there. So just using a Gaussian model for value at risk or expected shortfall is somehow nonsense, because it doesn't show you really the possibilities which can happen and often happen, which much more often happen than in a Gaussian world. Say here the 250 months, a 10% daily drop in an index price. In the Gaussian world, it does not occur. So if you calculate your value at risk in a Gaussian model, it says you have no daily loss of 10% ever. So yeah, I think it is a good idea to abandon the Gaussian assumption in value at risk modeling and also in asset allocation.
That's a very, very relevant point. Well, thank you for joining us in the anti-Gaussian crusade today and for providing some very interesting alternatives. And we hope we'll have you on the show in the future. Have a good day.
Thank you very much. It was my pleasure.
Thank you, Jörg, for sharing your expertise, and thank you to all that have joined us today. Please go to PRMIA's website at www.prmia.org to find more upcoming thought leadership webinars and information on joining PRMIA as a sustaining member to gain unlimited access to our weekly webinars. Thank you for attending this webinar.